Let's provide investors and brokers a little more advice. How should they evaluate liquidity when planning a trade?
Well, the easy answer is that the ETF is as liquid as the underlying. That's rule number one, right? Mm-hmm. It's a little bit simplified and so on, and there are different layers in this answer, but that's the first rule.
But is it really the under?
It is with friction costs.
Okay.
So and operational frictions, especially in Asia. So that's a message for all you exchanges and trustees and so on. It's the simpler it is for us to provide liquidity, the better the liquidity is going to be. So anything where everybody takes a cut from start to finish, and creation costs are about 60 pips before I even can manage to pretend to put a commission, is going to be reflected in the prices to the investors. So my dream is to work. The liquidity accessible to investors is also a function of the cleanness of the ecosystem in which the ETF trades.
Basically, what I think Amr is trying to say is that in many cases we might have a situation where someone comes to ask for a price in a Hong Kong listed fund from an international issuer who has the same fund also in the US and in Europe. And my price on the Hong Kong listed one might be a lot higher than in the European or US listed ones, because there are certain levels of fees which we need to pay in order to create the fund, and everyone wants a small cut. So it might be wise to, quite often it seems everyone is looking at, okay, which fund do I want to have? Whereas you actually could look at it as well as what's my execution cost of that specific fund, because it could also vary. And the way to do that homework is to basically ask that question to one or two or three firms, either your broker, who you know is good in dealing with ETF execution, or if you prefer to trade directly with market makers, then ask those market makers.